In case if you are in a hurry, you can go to the one last part of the material, after each unit, that is, let's sum up. This thing will be there. In this, the entire chapter or unit, a filtered version will be there, which summarizes the entire unit in a very neat fashion, where you can get the entire gist of it, okay, without going through the entire chapter. So that is a very useful technique. So let's sum up. You just check it out in the material. If you are short of time, you can get the main points there. Let's sum up, that one. Okay, so in the first block, managerial economics, 5 units were there, and almost all the units I have tried to cover within the given time span. Okay, so anyone who wants to join the WhatsApp group, there is a link given here by Ravi Ranjan. Please check it out. All the others. So that one. Now I will start with the second block. In the second block, 6 units are there. That is unit 5. Till unit 5, it was first block. And continued from 6 to 11, second block will have the entire details on accounting. So I'll tell you about all these things today.
Madam, okay.
1 minute. Sir, yes, sir.
Yeah, continue, madam. Continue, madam. Nothing. Continue, madam.
Yeah.
Okay.
Yeah, right.
I'm leaving the meeting. Okay, you continue.
Yeah, right, sir.
Right.
Okay, students. ಇಲ್ಲಿ ತಗೋತಾ ಇದ್ದೀನಿ. We will start this session from Unit 6, Block 2, Unit 6. For your reference, Block 2 and Unit 6. So first, session. All of the block 1 was unit 1 to 5. Okay. So now it is unit 6, first one. So we will go on with this. Okay. I thought some more people are coming in and we will admit them in a few minutes. Okay. Shall we start, students? Are you ready?
Yes, ma'am.
Right. Lankesh,
Yes.
first
Madam.
session you didn't attend. Which RC are you?
Yeah, ma'am. Sorry, ma'am. I can't.
Yeah, no problem. Tell me from where you are.
Ma'am, I am from Jharkhand in Ramgarh district.
Jharkhand.
Yeah, ma'am.
Hmm. Okay, right. Then who else? Many others joined. Okay, without wasting time, I will go on with the syllabus, so that a quick version of what we can do, what we can understand. And I congratulate and thank you again for joining, because on a Sunday, everyone will have their own priorities, like going to a movie or going with the friends. But all of you have joined here for the learning purposes, which I think is an achievement in itself, right? So we will start the session, Introduction to Accounting. So how much of accounts does everyone know here? I don't know, because this is an heterogeneous group with different backgrounds in their studies and different accessions, isn't it? I think many of you might be from commerce or accounts or different other streams. I don't know. We can discuss each one of you what you have studied, what is your background. But yes, RP Singh, you want to say something? Like this. So I think few of you have studied accounts and few of you might have not. So we will, this is very user friendly. They in that way they have given this version. So we will start with the introduction to fundamentals of accounting. First thing is, what is accounting? What do you mean by accounts? What is accounts? Where you got this word? What does it mean? Isn't it? So, see, in the cradle of commerce, we can see several first things done in the process of business, trade, and commerce. So man first started the commerce when he had an excess of something. He tried to trade it with what he doesn't have. That's where commerce started, right? At that stage, there was no accounting. And during the barter, what you call barter stage, even that time, there was no accounting aspects. People would buy what they want. So when people were having a commerce aspect to their activities, there was not much of accounts done in those stages. Slowly, when people started visiting other countries for trade, and when they traveled across the nations, like we know the very famous Silk Route, moving from Iran, Turkey, Tehran, across the Afghanistan, and finally India, and furthermore. At that time, we couldn't find traces of accounts, right? Slowly and steadily, we see the company format being predominantly used. Isn't it? Like the East India companies or several other companies forming their, finding their birth. So at this stage, we find accounts creeping in due to several reasons, maybe internal reasons or external reasons, or for government laws and records, so many other reasons. We see accounts creeping in, isn't it? So at the outset, there was no accounts in commerce at the starting, at its birth. Why accounts became prominent and indispensable, isn't it? Now we can't think of a business without accounts, right? So when that is the case, then we can understand the importance of accounts now. So when we have an back view of the business process, commerce, trade, then we find accounts not coming in at the starting, but maybe in between, because of several legal and other restrictions and other needful things to be done in the account. So first thing, we will understand what is accounting. So this is one little bit of history we have to keep in mind while studying the accounting aspect of commerce, where it appeared and why it. Okay, so here we can see what is accounting. So see, in simple words, it is a process of recording financial transactions pertaining to a business. It includes summarizing, analyzing, reporting these transactions to several agencies, regulators, and tax collection entities. The financial statement used in accounting are a concise summary of financial transactions over an accounting period, summarizing a company's operation, financial position, and cash flows. Okay, so this is several definitions are given by several association organizations. Several prominent definitions are given. Check it out in the material, or you have your Google here. You can check so many definitions about accounts and accounting according to experts, according to academicians, or according to the various organizations monitoring the accountancy scenario, isn't it? So like this, we can have a various different versions of it. So going forward, objectives of accounts, why we need accounts. Okay, so to maintain and record financial transactions, depict financial position of the company or business or firm, whatever it is, to ascertain the profit and loss or loss of the company, and information to other stakeholders to have better control of the firm. Definitely, yes. So all are these objectives. Simple, put in simple words. Going forward, there are users of accounting information. Users, internal users are there and external users are there. Very simple. Internal users, several departments, partners, employees, several levels of management may want the information, right? So, and external users may be investors, government, legal bodies, lenders, suppliers, general public, researchers, like that. Several external users also the may need this information. One joined in now, 1 second. So this is the users of information. Anything else can be added here? I think everything is included over here, inclusive. Shall I go on to the next slide? Students, hope you are all there with me. Yes?
Yes, ma'am.
Right. So different branches of accounting, input in simple terms. There is financial accounting, cost accounting, and management accounting. Three major bodies of accounting, each having its own significance and each having its own importance. Like that, we can have this different types of accounting branches. So next one, accounting systems. What are the various accounting systems? I hope all this slide is visible to all of you. So various accounting systems. There is general accounts, sales accounts, purchases account, all different departments. We will have their own accounts, and each one, and nowadays almost everything is computerized. No manual accounting is done, isn't it? Yes or no? So all the accounts is almost computerized nowadays, and we need not rely on manual work now. 1 second. One second, some more people want to join in. After, okay. Oh, right. So, yes, students. Okay. So, accounting systems, suppliers, fixed assets, those are new to accounting. You know that each department has its own set of accounts, like sales department here will have its own set of accounts. Purchasing, similar way. Inventory is the goods in process or inputs, raw materials, all that is called as inventory. 1 second. Someone joined here. Then customers will have their own database, suppliers, fixed assets, like this. All the major components will have their own accounting systems. Put together, we will form the normal accounts, that is of a company. Each one will have its own different bifurcations done. Okay, moving forward. If I am too fast, please tell me, students. If anyone is having the difficulty in understanding, please let me know, because we have several things to cover. I'll have to be on a fast track. Okay. Hope you are all getting me and understanding what's being told. Okay, students.
Yes, ma'am.
Okay, right. So next one. See, students, while we are having the accounts to be done, there are two things to which we have to consider. One is concepts and conventions. Two things, major things in accounting basics. Okay, what is this concepts and conventions? So I'll let you know in this chart here what is accounting concepts and what is accounting conventions. So both of them are very important for accounts. I'll let you know in this chart here, next chart. So this is the concepts. See, students, two basic things are involved here. One is conventions and one is concepts. Concepts is the basic accounting concepts which make the accounts what it is. Okay, so there are several accounting concepts, but to name a few, I have put them in this chart here. I hope all of you can view it. Okay, so one by one I will make you understand what it is. Each one of them mean a different thing, and what it is I will let you know. Okay, so first one, we'll go clockwise. So first one, what is this accounting concept? First one, money measurement concept. First one. Several concepts are there, but few of them are most important ones I have listed here. First one, money measurement concept. What is this money measurement concept? Okay, it means what is measurable my money, that only needs to be accounted. Okay, this is called as money measurement concept. Like, for example, only quantitative things have to be accounted. That's what they mean. Means, see, if I help someone, if I favor someone, if I am honest, if I do a second, if I am having a very good feedback from the customer, see, that I cannot include in accounts, right? So only what is measurable in money terms I can include. That is called as money measurement concept. Very important in accounts, because for a debit and credit, we have to have a particular exact number. I cannot tell 100 kgs of honesty or 100 kgs of time discipline, right? So only what is measured. So say sales I have done this much, 10 lakh sales, I can measure it. Then transportation cost, some 10,000. Yes, I can measure it. Then what else? Purchases, raw materials have been purchased. I can measure it, right? So only that which can be measured, which is measurable, is to be included in accounts. That is first concept, money measurement concept. Hope you all followed it. Second one, going clockwise. Second one is going concern. Going concern means, students, this is relating to the company. Means what time comes and goes, but company will be there forever. That's what they say in the Companies Act. Means the company is an individual, and that company has a name, and it can be sued in the court. It can buy and sell property. It can invest. It can do anything as good as an individual. So that is called as going concern. Means accounts thinks that company is forever and it will is a going concern. There is no end to the company unless it is legally wound up. Okay, that is called as going concern. Until and unless the company is closed down, the accounts will be there together with the company. This concept is called as going concern. Okay, shall I go on to the next one?
Yes, ma'am.
Yes. Next one is accounting period. So what is the accounting period for a company? What is the accounting period?
Generally 1 year. Sometimes it is half yearly also.
Definitely it is 1 year, annual year. So whether it is a budget, whether it is a account of a company, whether it is an accounts of a particular firm, everything is taken annual year basis. Whether tax is being paid, everything is taken annually. Okay, so accounting period, the concept here mentioned is for an year, that is annual year. But for the company's sake, they may divide it quarterly, half yearly and all. That is dependent on the company. But for government purposes, for company law purposes, for registrar of the company purposes, it is annual period is 1 year. That is, the accounting period is 1 year taken annually. In other nations, it is Jan to December, whereas in our nation, it is March to April, April to March. That is the circle. That is March to March, what they say. But anyhow, it is 12 months period is there for the accounting period. Okay. Okay, it is understood.
Yes, ma'am.
Shall I move on?
Yes, ma'am.
Yes. Yes. Next one is objectivity. I told you in the first session itself. What do you mean by objectivity? I told you. That is, objectivity means there is no individual influence or individual bifurcation here. Sales means sales. Purchase means purchase. That is, objectivity is very clear here. Even if it is between father and son, in accounting, they remain as persons. If he is a buyer and a seller, it goes to sales and purchase account. There is nothing like any other way in accounts. That's what they mean in objectivity here. Okay. So that is the objectivity concern here. Next one. I hope you understood. Any doubts there? Any doubts there?
No,
No,
ma'am.
ma'am.
Okay. Next one. is materiality. Okay. What is materiality? Concept. Here, accounting concept recognizes the material aspect of life. There is nothing else here to be the need, like there is no spiritualism involved or immaterial things is not involved. That's what they mean here. That is, what is, everything is in money concept. What comes and what goes, only that is measured. Hope that is materiality concept. Materiality means only the measurable things, only what is material, only which is measurable by money is taken into account here. Okay, that is material concept. What accounting says, don't give any prominence to immaterial things. Accounting says, only I want material records and books, not anything else. That is what is materiality concept. Next one is conservatism. What is conservatism? Here, conservatism means anticipating future losses instead of gains. That's what accounting says. Play it safe. Don't expect too much profits. This is also called as the doctrine of prudence. Okay. So in accounts, they say in the doctrine of prudence, it states that be conservative. Don't expect anything. Don't expect future profits, huge profit. Go slowly. See each paisa as it is. Okay. Don't splurge. Expect gain. Do not expect more gains. If it comes, well and good. But do not expect more gains. Anticipate the losses and be aware. That's what conservatism says. Okay. Next one. Next one is being consistent. Consistency. What is consistency means? There is no too much high and low. You have to be consistent. That is one of the concept here, accounting concept. Whatever you're doing, whatever accounts you're showing, it should be consistent. There is not like one day you show high number of entries and the other day you show the less amount of entries. It's not like that. In a month, whatever be the records, it has to be there irrespective of whatever the business is undergoing. That is the consistency here. Then next one, full disclosure. Full disclosure. What is full disclosure means? Is no transparency is to be involved in accounts. There is no other way about it. There is no hidden facts in accounts, isn't it? If there is hidden facts, you know what happened to so many other companies which had window dressing accounts, their accounts, isn't it? So we have several examples of such things done illegally. So there is full disclosure. There is no chance of window dressing your accounts or showing some other number to please someone, isn't it? That cannot be done. That is called as full disclosure and transparency. Next one. Hope that is understood. Next one, matching principle. What is matching principle in accounts? It's nothing to do with the dresses or something like that. So matching principle means the for every debit, there should be a credit. That is the matching principle. Okay. In accountancy, for any debit, I'll come to debit and credit. In the journals, we have debit and credit. So in a journal entries, each debit, whatever you debit, there should be a credit. Don't think of karma and all that here. But in accounts works on this principle. For every debit, there is a credit. Definitely, as life gives us, similar way, for anything good you do, there is an reflexive action, right? Similar way here, not to uh, uh, concur with that here, we am telling about the matching concept, accounting concept, where for each entry there is two entries here in account. One is debit entry and one is credit. Any transaction will have two entries. That is called as the matching concept. Next one, reverse recognition, revenue recognition concept. Revenue recognition is very important in business, students, because in business we have two things. That is, one is capital and one is revenue. Okay. So what is capital? What is revenue? We have to have a clear-cut understanding in between these two. Otherwise, there is a problem in both the accounts and both the concepts. When we are entering also, there will be a problem. So, second. So here, you should be clear about what is revenue. In detail, if I want to say, that will take a long time. Anyhow, just touching on the accounting concepts here, revenue recognition is very important in account as an accounting concept. We should have a clarity. What is revenue? What is capital? Okay, that is very important. I think you can go through this in the material. Lot of things is given here on this concept. Please go through it, because in this limited time session, we have to give justice to everything. So I'll have to go to the next one. Shall I move on to the next one, students?
Yes, ma'am.
Okay. Hope everything is, the concepts are clear. There's even one-liners, if you are able to recollect, that would be very helpful. Then next one, dual revenue recognition on dual concept. Dual concept is similar to this matching concept. Dual concept means the duality in the accounts should be recognized. Means, see, when I buy goods, two accounts are affected. One is cash account and one is purchases account. So this is called as a dual aspect. Two sides of accounts are affected here. Okay. When I am selling the goods, then sales account is affected and my cash account will be getting some cash. That is called as dual aspect. So when there is a duality in accounts, that is called as a dual aspect of accounts. Duality in accounts, that is, two accounts will be affected when there is a transaction. 1 second. Next. Someone entered and I have to get back. Next one, cost concept. I told you everything has to be having a cost aspect to it. That is, I told you so many departments have their own departmental accounts. So when there is a marketing department, it will have marketing cost. Sales will have, department will have its own cost. Purchases department will have its own cost. Like that, all these costs put together will go to the cost concept. That is, what is measurable in cost, that only we have to undertake, not anything else. That is what they mention in cost concept. What is measurable and which can be routed to that particular department. Can I route this cost to particular department? Yes, then I have to take it into accounts. If I am not able to route it to a particular department or to a particular cost, then I cannot take that as an accounting transaction. I hope you understood this. Okay. So this is the cost concept. Next one, business entity. So accounting concepts are not done at a macro level. That is, for a team of industries, we don't do it, isn't it? So it is done on single business entity. Then we can take it as an entire industry. The statistics can be taken for industry, but accounts we are doing for a single business, not collectively. Okay, this is called as business entity concept. All these are called as, put together, are called as accounting concepts. Okay. Any doubts in this? Go through each one of them. If you have any doubts, please tell me. Okay.
Yes, ma'am. Please continue.
Okay. Similar way, I have accounting conventions. So what is a convention? Accounting conventions. This is throughout the world, it is there, not only restricted to one country. Okay. They are the guidelines. Accounting conventions are the guidelines which help the company determine how to record and how to record the business transactions, and maybe sometimes which are not inclusive in this accounting standards. So these conventions will give you the answer that time. Okay. So maybe which are not addressed by the accounting standards, like accounting standards of India are there, several international accounting standards is there. Okay, IASB boards are there. Then Indian accounting standards is there. But these conventions tell you maybe which is not covered. Some aspects may not be covered by the boards and may not be addressed by them. Such things, these conventions take care of these things. Okay. So this is the conventions. Major ones I have given here. It may differ. Sometimes you may one or two may be added here by some, but major ones, oft repeated ones, I am giving here. Convention of materiality. I told you only material aspects are included and not which is not measurable cannot be taken. Then next one is conversion. What do you mean by conversion? Is the way the conventions which seek to tell you how to convert the particular transactions, means to place them to the proper department, or if there is a confusion between the real nominal accounts, then how to place them in a proper, convert them in a proper way. Some discussions may be there on the origin of the particular line of accounts. Then maybe this conversion may help you answer them. So this is the convention of a conversion. That is, when you are not knowing the exact origin of the entry, then you can choose to understand it by means of a convention of conversion. Next one is consistency. Consistency means, I told you, for one period, if you have applied a particular accounting principle, then for the next period also you should make sure that you have used the same accounting principle. Okay. If you have used one particular way of the accounts in your first cycle, and second cycle you are used some other thing, then it is not consistent. So for different accounting cycles, you should have a proper system in place, and see that your accounting department also is in tune with this, and they know what is the particular convention of that particular company, and go ahead. Okay, that is called as consistency. Then full disclosure, I told you already that there is full transparency should be there. There is no hidden accounts, or there is no scope for hidden accounts. Full disclosure should be there, especially in companies. That is the conventions here. Next one, I will go on to tell you about next. What I have here is accounting records and systems. I told you, preparation of accounts, how to prepare the accounts. So especially farm accounting, that is agri business, if you are doing, there is a separate bifurcation called as farm accounting. But to do that also, we have to know a little knowledge on accounts. Okay, so what is account records? What is record keeping? I have put it here in few words. Okay, so see here, record keeping, accounting records, how to identify the records, what to do in accounting records. So first one, identifying the transactions. I told you, I'll come to the next slide also. I'll tell you how to identify the transaction. First you understand the point here, identifying the transactions. I'll tell you again in the next slide what are the transactions. Okay, so first step you understand here, that's enough. Then second one, recording in the journal. Journal and ledger are the main books in accounts. So journal is the first book of entry. In that we have to, whatever is done is entered in the journal first. Okay, see, irrespective of department, it is entered in the journal. Okay, a company has several departments: HR department, accounts department, finance, accounts and finance department, sales, marketing, purchase, R&D, like that. Several departments may be there. But all the records first will be entered in the journal. Then it will go on to the particular ledger. That is, sales ledger will have its own sales information. A purchase ledger will have its own purchase information. Like that, we bifurcate in the ledgers. Okay. So that is what here they have given. Recording in the journal, classifying the nature of transaction. Means I'll tell you what is the classification. Posting to the ledger. I told you all the entries will first appear in journal. Whether it is transport cost of 100 rupees or sales of 1 crore. All will appear in the journal. Then it will go on to the particular department. In the ledger, it will be bifurcated. Okay. So that is what. Then balancing accounts will happen. Then preparing a financial statement, interpreting the statements, communicating to the stakeholders. This is the records. Next one is classification of accounts. So in accounts, we have 3 classifications. One is personal accounts, one is real accounts, and one is nominal accounts. That is impersonal. That is, one is 3 major things: personal, real, and nominal. Okay. So what is personal accounts? Can anyone tell me just like that? Or whoever, any student, can you tell me what is personal accounts?
Personally, it is of a person.
Yes, with reference to a person, whatever accounts are for, that is in the name of individual. Okay. If the accounts is in the name of an individual, then it becomes personal account. Then individual means here a company also is there. Okay. That is, a company is an individual itself in the eyes of law. So personal accounts will have individual, companies, and all these things in some name, in a particular name, that becomes personal accounts. Then what is real and nominal accounts? Okay, we will find out what is real and nominal accounts. What is real account is an account dealing with the material assets of a business. That is real accounts. Like land, property, machinery, all this becomes real account. That is material assets. Assets which are visible, assets which are felt. That is called as real accounts. So an account dealing with material assets of a firm, that becomes real accounts. That is it comes under impersonal accounts. Next one, hope it's clear, students. Students, hope it is clear.
Yes, ma'am. Yes.
Yes, ma'am.
Yeah. Next one, nominal accounts. Nominal accounts means gains and losses. Anything relating to the gain and losses is called as nominal account. That is, any receipts and payments, gains, then it is called as nominal account. That is, they are used for understanding the gains and losses of a business. That is accounted under nominal account. These are the 3 major accounts of a business. That is, I hope all of these 3 you understood. All nominal accounts include expenses, losses, incomes, gains. All these are coming under nominal accounts. Okay. Next one. I will tell you the rules of accounting. This is a basic things we understand, what is called golden rules. golden rules of accounting, we tell these as the golden rules of accounting. So personal account, the rule is debit the receiver and credit the giver. Okay. Say if Mr. X receives 1 lakh from Mr. Y. So what is the transaction? Mr. X receives 1 crore, whatever amount, from Mr. Y. So what will be the entry? Mr. X account debit to Mr. Y's account. That will be the entry. Okay. In the ledger, journal entry, I think you know how to keep the journal. First column will be date, serial number, date, particulars, two amounts. Two amount column will be there. So personal account, I told you Mr. X is the receiver, Mr. Y is the giver. So Mr. X is receiving 1 crore. Just I am telling imaginatively for your reference. So how do you write the transaction? Date you should write in the date column. If there is a serial number, you can write the serial number. Then Mr. X account debit, DR we write for debit. Then to, second line we write to Mr. Y account. And in the amount column, debit we write 1 crore, credit below that next line, sidewards you write again 1 crore. So both the sides, debit and credit, you should have the accounting done here in personal account. Okay. Hope you understood. Students?
Yeah.
Ma'am.
Yes. Next one, real account. Real account, I told you, is the regarding the assets of a firm. So debit what comes in, credit what goes out. Okay. So you bought something for your firm, machinery, land, building, assets, whatever it is. So company ABC company buys machinery, say 2 crores machinery. So what will be the entry? So debit what comes in. So machinery is coming in. So machinery account debit to, from where you have bought that machinery, okay, to ABC company. That will be the entry. Hope you understood. Same way you are selling something. Say you are selling, your company is into sales of some agricultural products. You are selling something, then your sales is amounting to some 15 lakhs. Then what will be the entry? Then it will be, say you are selling to one some company by name KR, company KR you are selling. So KR account debit to sales. Okay, that will be the entry. Because credit what goes out. Okay. Like that. We can give students in the material, there is several examples. Please go through. After every unit, there is several examples for accounting transactions, recognition of accounts, classification of accounts. They will give few instances. What is the, which is this account, like that. You can recognize and classify the accounts. Such exercises are there. Please go through that so you will understand it better. Okay.
Yes, ma'am.
Yeah. And also journal entries are there. Journal entries, you have to do it on your own. Like that exercises are given. Do that as a homework. Okay. So you will understand these things better. Last one. Debit to the nominal account. It is regarding the expenses, losses, gains, profits, everything comes here. So here, what is the rule? Debit the expenses and losses, credit the incomes and gains. Okay, this is the rule here. Debit the expenses and losses, credit the incomes and gains. So like this, we can give the examples for personal account, real account, and nominal account. In a classroom, we can have solved the various journal entries, ledger entries, accounts, how to post it in the ledger and all that. Okay, we can do that. Definitely. Hope you can all solve the such exercises which are there in the material. Please go ahead with that. Okay, then you definitely it will be fine-tuned. Your knowledge will be fine-tuned that time. Next one. So here journal, I have told you, it is a detailed account that records all the financial transactions of a business to be used for the future reconciling of accounts and transfer of information to other official accounting records, such as the general ledger. I told you, journal is the basic book of accounts. This is the first book of, it is also called first book of entry. Okay. So any transaction will find its entry in the journal first. Then only it will go to the other various other different sectors and departments. Okay, so this is the journal. Next one. See, journal entry examples I have given here. Please see here. So account like this, it will be particulars. Here actually date column will be there in the first, because date has to be there so that they can bifurcate on the accounting year. So if it is which year it comes, they'll stop till there, isn't it? So date is very important. Then particulars will be there like this here. After that, debit and credit like this, it will be there. And at the end of the page, they will balance this. Debit and credit should be balanced at each page. Okay, like this, the example. See here, purchases account debit to accounts payable, machinery account debit to accounts, like this. Various different examples is being given depending on their whatever they received or whatever they paid, like that. Okay, so I think you understood the next. I'll take general ledger. So once the accounts are entered in the journal, it will find an entry in the ledger, second book. So it's a complete record of company's transaction on in different in the general ledger. You will have different accounts which will go into that account. Say sales ledger. See, first general ledger will be there. Under that, several books will be there. That is sales ledger, purchase ledger, assets, like this. Different ledgers will be there. And once the journal entry is posted in ledger, then it will be again posted to the sales ledger and purchases ledger and different other ledgers as per their dimensions. Next one is the trail balance. Next important thing in accounts is the trail balance. Here, see here, all, I hope you can see it here. There will be a particulars column and debit and credit. So whatever is posted in the journal, it will have to be in the trail balance. And see here, there will be different bifurcations here. And whatever is debit will come on debit column, and whatever is credit will come on the credit column. And finally, it should be tallied, because I told you each debit will have a credit. So both the sides of a trail balance should be tallied. That is the first step in accounts. So first we'll have the journal. First it will be in the journal. Second, it will go to the ledger. In ledger, there will be different bifurcation: sales ledger, purchase ledger, machinery account. Like the different accounts will be there. It will go to that individual account: cash account, bank account, sales, purchases. Like that individual ledger will be there. So whatever is posted in journal will go to the ledger. Then we can prepare the trail balance. Trail balance means whatever is in the journal will come on the trail balance in debit side and in the credit side. So Rajesh, yes, first two sessions you didn't come, Rajesh. Okay, welcome. Anyways, I'm doing an accounting, basic rules of accounting, and hope you can join and understand now. Anyways, here, okay. So trail balance, in trail balance, we will understand all the debits will come here, all the credits will come here, and it has to tally definitely, because each debit will have a credit, right? So it will have to tally in the trail balance. Then we will have the trail balance. After that, we will have, see here, see students, this is an example of a cash account. I hope you can see this. Okay. So in this account, see here, we have two columns here. That is, one is on the debit and one is a credit here. And both will have four columns, that is date, particulars, JF. JF means journal folio. Journal folio means the page on which this account detail will be there in the journal. That is called as JF. Okay. And then amount. So here, see, whatever in cash account, it appears, you have posted the entry cash account debit to capital account. So here it comes on debit side. Debit side is usually the left side and credit side is to the right side. Okay. So here your returns in March 1st to capital account 80,000. And see here by purchases. That is, you have given credit to the purchases. So here it is showing a credit here, and debit side entries will come on the debit side. Cash account debit will come on the debit side. What is come to cash account, whatever has come, that comes on the credit side. Purchase, machinery, some individual account, rent account, drawings account, all come to the credit side. And finally the account is balanced, and any difference it is given to carried down, balance carried down. So it is coming on the next to balance carried brought down, it comes on again on the debit side. So this is an example of a cash account. That is, after I have posted in journal, ledger, and finally cash account. I've put it in an account format now. Okay, students, I hope you understood this. Hello?
Yes, ma'am. Yes.
Okay. I know it's a tiring day and weekend. Anyways, next one. But when you speak, no, I'll know, yeah, something has been understood, isn't it? Huh? Because without reaction,
Yeah.
it becomes difficult for us to involve here. Hope all of you are there with me.
Yeah.
Yes, ma'am.
Right. Okay. Shall I go to next screen? Okay. Important accounts. Okay. So finally, students, three main things are very important in accounts. One is trail balance. Trail balance, I told, no, this one. See, this is the basic book of accounts. That is, all the journal entries are posted here on debit and credit side. Okay. So I'll have every account here which is appearing in the journal. So this is called as trail balance. This is the first thing I do when I prepare the accounts at the year end. Okay. After this trail balance, then I'll do the P&L account. P&L account means what? Profit and loss account. So after trail balance, I do the profit and loss account. In profit and loss account, I write all the expenses and gains and losses and expenses. Everything I write it in the profit and loss account. Whatever is the expense, whatever is my gains, how much I have got from the my sales, all these things will appear in profit and loss account. And finally, I'll take the balance sheet. First, the balance sheet was T format, that is assets on the right side and liabilities on the left hand side. But now it is straight line format is there. That is, both the formats are mentioned in the material. Please go through that and you will understand the basics of accounts. Okay. So this is a simple view of how accounts is done. Okay. Any questions? On this? If any questions are there, I will take it now.